Hello. In this video, we're going to start talking about financial statements and why it's important to model financial statements. All right, so when we think about financial statements, a lot of times they can be, just out of a 10K or a 10Q, and you're looking at annual or quarterly reports from big companies, right? And in a lot of your accounting classes and finance classes, you take those as given and then analyze something about them. You look at financial ratios and try to understand something about a company that way. We're going to take a different perspective here in financial modeling, and instead we're going to think about projecting financial statements forward, right? We're going to have a business idea in mind that we need to put down on paper to actually make a financial model out of. And so when we think about why we should do this, why go through the trouble of building financial statements, there are a couple reasons. One of the first reasons is it helps discipline our model, right? Or our business plan, rather. Right? When we're thinking through a business plan of this is how I'm going to make money, here's what I need to do to make that work, by having a financial model, you really have to think through everything. You have to try to get as much detail as you can into that plan. And so it really disciplines you into, kind of dotting every I, crossing every T, making sure every financial account has been thought of and considered. And we'll see that as we go through this example. Another reason is to analyze your decisions. Right, at a certain level, you want to know, okay, if I change my purchasing terms, or if I, buy this machine or not, how is that going to affect the financial picture of my company, right? Having the model built allows you to see how those decisions impact your financials, your profits, your bottom line. And then finally, it allows you to value your business. One of the big things we do in financial modeling is ultimately get a business value back out. We'll talk about that as the semester progresses. It allows you to value your business and then ultimately go out and raise money. Usually that's a big concern of both startups and more mature companies. How do you get access to capital? Having good financial statements, a business plan that backs them up is crucial. All right, so let's get in how we're going to do this functionally. And to do so, I'm going to give you guys a very simple business example we're going to talk through. So I have a couple projections out here, and let's just kind of walk through them. First, what I'm going to imagine, and for this example, we're going to think about your business of selling candy on campus. All right, that's going to be your business plan. What you're planning to do, you said I'm going to sell 1,000 units of candy. I'm going to charge $4 a unit, and it cost me $2 a unit to buy the candy. All right, that's going to be the start of our business plan. We're going to put that into an income statement and a balance sheet, and we're going to slowly start adding more and more of the components that it'll take to actually realize this business plan. So that's our building block. We'll add more pieces as we go, but first let's talk about the income statement and the balance sheet. All right. You can see over here to the right, I have my income statement, and it's a very simple income statement right now. The first thing we have to talk about, though, are these periods, right? We have period 0 and period 1. We have the same for our balance sheet down here, balance sheet period 0 and period 1. So it's really important now to get an idea of what the difference is between the income statement and the balance sheet. The income statement is going to keep track of whatever economic activity occurs during a period. So given that period 0 is kind of before our business starts, we don't need that for the income statement. Period 1 is going to encapsulate all the economic activity that takes place from when we start the business at time 0 to time 1 at the end of the first, say, year of the business. It could be a year, it could be a quarter, it could be a month, the end of the first period. So that income statement is reflecting all economic activity in that period. In contrast, the balance sheet is always going to be a snapshot. Right? So we're going to have at time 0, when we start the business, that'll be what do our accounts look like at that point in time, at that moment in time. We're also going to keep track of what everything looks like, what all of the account balances are at the end of the first period, or at time 1. Again, it's a snapshot at that time. So while the income statement keeps track of everything that happens over a period of time, the balance sheet merely takes a snapshot, in this case, at time 0, sorry about that, at time 0, and then again at time 1. All right, so let's think about how we're going to build this. So let's start with the income statement. Well, our net sales, we're going to go ahead and reference our units input times our price per unit. Right? Revenue is just going to be number of units sold times the price, in this case, $4,000. Our costs, well, again, number of units sold. Let's multiply that by our cost per unit. That'll give us 2,000. And if we're going to calculate our income, just revenue minus costs, we made $2,000 over that first period we're in operation. Now let's see how that affects the balance sheet and importantly, how it ties into the balance sheet. So starting at time 0, let's fill in what we can. This is kind of the simplest balance sheet we can ever come up with. It has cash on the left-hand side. Traditionally, assets are on the left-hand side. And then liabilities and owner's equity are on the right-hand side. We're reflecting them on the bottom of this balance sheet. And so let's start filling things out. Retained earnings. All right, that's going to be the one liabilities and owner's equity account, or assets or equity and liabilities account, that you have to have. This keeps track of all the money the company has ever made, minus any distributions. All right, that's basically what it does. It's just a scorecard. How much money have we made? When we start out this company, it's going to be 0. We haven't made any money yet. And now if we go ahead and add up all of our equity and liabilities, we add them up, we're at 0. All right, one thing about the balance sheet, and this is always true, is that the balance sheet balances. So in this case, our assets must be equal to our equity and liabilities. I'm going to show you a method here of building a balance sheet that backs into cash. All right, cash is going to be the last thing that we solve for. And in doing so, we're going to mechanically set our assets equal to our equity and liabilities. And that's what I'm doing in this cell. Now notice I've broken out cash as a current asset. Typically on a balance sheet, you see current assets as well as long-term assets. So I am breaking that distinction out now. We'll build on that as we go through this example. We're going to start out and say current assets are equal to our cash. It's just going to add all that up. And now our cash must be a value that basically makes the balance sheet balance. So it's going to be your total assets minus anything else. There's nothing else to subtract right now, so it's really just equal to our total assets. So we've set up our balance sheet. Let's copy that over to period 1. So I'm just taking all those same formulas, I'm copying them over. But the one thing we have to change and we have to adapt is our retained earnings. Because our retained earnings, again, is kind of a scorecard of how much money have we made ever. And whenever we're modeling a balance sheet account, except for cash, which we're backward solving for, we always want to think about what was it last period, and then plus or minus any changes that took place. So in this case, we're going to set it equal to the previous period, and then what change took place? Well, the only change that really takes place is our net income. Net income flows into retained earnings. Net income is how much money we made this period, and again, retained earnings is how much money have we made ever. So in this case, we're going to reference our net income this period. We now see that our balance sheet updates. Total equities and liabilities is also 2,000, as is total assets, current assets, and cash. Over that first year, we make $2,000. That all flows into our cash account. Again, this is a very simple version of the model. We haven't really thought about a lot of other different features we can incorporate, and that's what we're going to do in these next few videos. And so you'll see really, as you think through your business plan, you discipline that thought process by putting it into the model, putting it down in the spreadsheet, and seeing how it affects your outcomes, your cash, your profitability, etc. And one last thing we're going to add is that at the end of the day, we want to make sure that our balance sheet actually balances. Right? It's really important that it balances. That's what it does, and we want to check to make sure that that's true, and we can do so and add a nice little visual indicator. So in this last line here, I have a line that says balance sheet balances. Notice it's kind of light gray. It's not something I want to call attention to, but I do want to be able to see it. And here I'm just going to set a simple cell that says F14, total equity and liabilities, equal to total assets. When you do an equal condition like this, it's going to give you either true or false. So in this case, I can see that it's true. Let's copy that over to the other column as well. And now I see that both columns, times 0 and time 1, my balance sheet balances. So that's, again, just a nice visual check that everything's working. So that's a nice piece we'll add to most of our models.